Hey, Cecil Robles here, and in the last video, I covered what we consider account size and really how you can trade Forex even if you're starting with a relatively small account size. Now, in this video, I'm going to cover some meatier stuff. We're going to get into breakouts and breakdowns here in just a second. But in video 7, I'm really going to blow your mind with some stuff that I've never shared before. So make sure and watch each of these video series. I want to get you up and running in this business as quickly as possible, and you can benefit from all of the knowledge and wealth of information from all of my students and from my over decade-long experience in the trenches in Forex and really in trading millions of dollars in this particular market. But we do have to cover some of the basics here as we get through this stuff to get into the stuff that you're going to be able to then take and really apply every single day and make money from this market, just like me and my students do right now. So let's talk about what it means to go long and what it means to go short. Some of you may already know this, but listen, go through this particular video because you're going to learn stuff that you probably already don't know. I can promise you that, because I'm going to get into breakouts. I'm going to get into breakdowns here in a minute. I'm going to get into some other stuff. You're really going to want to pay attention to this. So make sure and watch this video all the way through, even if you're familiar with what going long means, with what going short means. Now, going long simply means that I am buying at a lower price and I'm investing in a particular currency in hopes that that currency is going to go higher as opposed to going lower, right? So going long simply means I'm buying. But going long isn't the only way to make money trading the markets. It's like in golf, right? If you're a golfer, you know that you can't hit the ball by simply addressing the ball, standing there, addressing the ball, not moving, but just simply swinging forward from the approach of your club to the ball. You're not going to hit the ball that way, right? You first have to swing the club back and then down and then through. It's called a backswing, a downswing, and a follow through. Well, as a trader, we don't just make money by going long or by buying the market, right? I've made a lot of money buying the market, but I've also made a lot of money selling the market. So I trade both ways. I go long and I go short, and the Forex is a great market for doing that. In fact, there's absolutely no difference between going long and going short. There's really no separate rules that you have to follow. There's no special strategies that you have to learn. There's no regulations that you have to pay attention to. You can buy the market, you can go long just as easily as you can go short, okay? And vice versa. You can go short just as easily as you can go long. Now, the value of the currency goes up, right? And the value of a currency goes down, just like the value of a stock or the value of a house or the value of any other asset out there. However, the main difference is that currencies are traded in pairs, right? So, for instance, the euro-US dollar is a currency pair of the value of the euro compared to the value of the US dollar, right? So if the dollar is trading, if the euro-US dollar is trading at 1.1345, then approximately it takes $1.13 roughly to make up a euro, okay? So 1 euro is equal to $1.13, all right? So that means that the euro is much more valuable than the dollar. When people come over to the U.S. from Europe and they buy our goods, they're actually buying them at a cheaper rate because guess what? Their value of their currency goes a lot farther here than ours does over there, right? But if the European economy is strong and the U.S. economy is weak, then the valuation of the euro is likely going to be stronger than the valuation of the dollar, right? And vice versa. Investors are more likely to put money into a strong economy than they are a weak economy. Just like, you wouldn't buy a company that had weak financial performance. You would buy a company that had strong financial performance. Now, I know there are exceptions to those rules, but, they're very few and far between. You're going to buy a company that is performing. You're going to buy an economy that is performing. It's the same with investors who invest in currencies. And by investors who invest in currencies, I mean, big time investors like banks and multinational corporations and hedge funds and so on and so forth. They are looking to place money where they're going to get the best return or the best bang for their buck, right? So they're going to put their money in a stronger economy, thus driving the value of that economy's currency up. If the European economy is hot and the U.S. economy is weak, guess what? More money is going to flood into the European economy, thus driving the value of their currency up, and the value of our currency compared to theirs is going to go down, right? Now, if the opposite is true, then the value of the U.S. dollar is going to be stronger than that of the euro, right? It's not very difficult to understand. If the U.S. economy is hot and the European economy is weak, guess what? You're going to have a weaker euro versus the U.S. dollar. It's very, very simple. Now, here's a perfect example of what I mean. In this chart, you can see that the euro lost about 25% of its value against the U.S. dollar in 9 months. What happened? Well, quite simply, the main reason for it was the European economy was much weaker than the U.S. economy during this period of time. And it still is. You know, the U.S. economy is hot right now. The European economy is still sluggish, and they haven't quite come out of that recessionary period yet. Now, you know, I don't know how long that's going to stay for. You know, obviously, the world economies are a very, very complex thing, okay? But the beauty is we don't have to know all of that complexity to make money from this. We just have to know the underlying principles of it and then take advantage when the patterns show themselves, right? And as a Forex trend follower like me and my students, you could have potentially caught about 70 to 80% of this trend by going short. You don't always have to go long. You can go short too. So by selling right here and by having a very tight stop loss here, you could have caught about 80%, 70% of this particular trend right here by selling here, once again, at this green line, by buying the market back right around this area right here as another pattern emerged here. And you would have earned about $25,000 for every one standard lot you had trading during this particular time. With a very, very small risk, by the way, a very small risk with a very large potential reward, risking about $2,500 to make about $25,000. That's not a bad deal right there. That's actually a pretty good deal. Actually, it was a little less, about $2,300 to make about $25,000. Now, that's over a 9-month period of time, so this is more of a long-term type of trend. But my point is that you can make a lot of money going short the market just as you can buying. And sometimes, actually, the majority of time, you're going to make more money going short the market than you are going to make buying the market, because I'm going to explain that here in just a minute. Now, here is the real beauty of being able to go both ways, of being able to buy and go long, or being able to sell and go short. You don't have to only make money if the economy is great. You know, sometimes the economy isn't going to be great, and that's okay. You can go short and you can make money on the way down. I've made some of my best trades by going short. I've made some good trades going long as well. But even when your home-based currency, right? Say you live in Europe, and the European currency has been losing money or losing value against the U.S. currency, right? Thus losing purchasing power, right? If your home-based currency loses value, you've lost purchasing power. The cost of goods are going to be more costly for you than they are for the country that is doing well, that has their currency at a higher price versus other currencies. Why? Because they can easily buy things a lot cheaper. Goods are cheaper. Their money goes a lot longer, right? It goes a longer way. So you lose purchasing power when the value of your currency drops. But you can offset this by simply shorting your home-based currency and buying another currency that is much stronger, right? So really, it's the best of both worlds. It's kind of like a hedge against economic issues in your own home country. Now, we're going to turn our attention here to breakouts and breakdowns. Now, this is slightly more advanced, but this terminology and a strong understanding of this terminology and what these things mean is very critical to your success as a trader over the long term. All right, so breakouts happen when a particular currency breaks out of a range and moves much higher in a relatively short period of time. Now, I know a lot of what you hear on TV from the talking heads, and maybe you've heard this terminology before, but you know, you're supposed to buy cheap and you're supposed to sell high. Well, that's That's partially true. But what they really mean when they say that is that you should try to buy at the bottom of the market and sell at the top of the market. But the only problem with that logic is that it's biased, right? If you think a market is bottomed out and you start buying at what you feel is the bottom of that market, you could actually end up seeing that market going a much lower, going a lot lower than where you thought the market was going to bottom out, right? If all you have is a long bias in the market, you could be buying into a continuously downtrending market, thus wasting precious trading capital and precious time that could have been used to make you money somewhere else during that period of time. All right, so you need to get rid of that mentality of trying to buy at the bottom and sell at the top. Now, there are some strategies that I'm going to teach you that are going to enable you to buy reversals and sell reversal patterns when the market is shifting. But listen, that doesn't happen all the time. The majority of the time, the market is in some kind of a trend, and you're able to figure out which direction is the best direction to trade, all right? And that's what we use breakouts and breakdowns for. So by buying breakouts, we're not trying to achieve buying the market at the very bottom, right? Rather, we're buying the market when it has the most momentum, and that is critical to our success because like my mentor, my hedge fund mentor taught me that momentum always changes before price changes. So as we're buying at the highest point of momentum, we have the most likelihood of price continuing to go in the direction of that upward momentum, all right? We're not getting into the market at the lowest possible price, but our odds of being on the right side of the market at the right time increase exponentially by buying breakouts. Here's an example of a breakout that we bought on the Great British Pound Japanese Yen. You can see here the green line is where the breakout was. You can see that it was a very simple breakout here. We had a high point in this particular market that we knew had some potential that if it got broken, price was going to continue to go in that particular direction. And then here is where the stop loss was. We always have a stop loss in our trade. I'm going to get into that a little bit later, but we always have an exit point. You know, I'm a very firm believer in buying the market. If we're going to be buying the market, let's let the market run. Let's let our profits accumulate, and let's let the market go up as high as it's going to go before we actually get out of that market. And let's cut our losses short. So we always have a stop loss in place here. But you can see the market broke out right here on this particular market, and look at where it is currently. We could still be in this particular market to the buy side by trading this particular breakout, another breakout right here, although that one was a lot further along in the trend, but you can see that the market broke out very swiftly here. So this market broke out very quickly. It actually closed above this particular breakout point here. This was an overall uptrending market. If you look at the long-term trend of this particular market, it is actually in an uptrend. So buying is a lot easier than it is to sell. When you see a market that's in a very strong trend, it's much easier to buy that market than it is to sell that market. So in this particular case, the market was already in an uptrend, and of course momentum is going in that direction. And here we see momentum increasing, and then boom, momentum explodes through, and then price explodes through with it here, and it continues to explode upwards as there is still upward momentum in this particular market. So this is a very nice, easy way to trade a breakout, all right? Now, here are some examples of both going short and going long. These are the going long examples. You can see here, these were buy signals here. The Great British Pound, the Australian Dollar, Japanese Yen, the Great British Pound, Japanese Yen. These are our favorite, some of our favorite pairs. But in these particular instances, we made 306 pips, 130 pips, 213 pips. Once again, if you're trading just one standard lot, right, that's $3,000. That's $1,300. That's $2,100 right there. And then here's some examples of going short. These are actual signals that we release on our watch list every day that our members get to take advantage of, that our students get to take advantage of, and our students get the profit on these as well. But you can see here that we have 542 pips in this trade. Once again, trading one standard lot. This was a sell trade. Once again, trading one standard lot here, you made $5,400. Here's one, only an $80 profit, but that's still $800 if you're trading one standard lot. All right, so these are examples of both buy and sell trades that we've taken. Here's another example of a breakout trade. Once again, we're looking for the market to break out of a certain level. Here, this is an uptrend already. The market has already been trending up. It's in an uptrend. It's had somewhat of a pullback here. And now you can see that price then breaks up through this level. Doesn't quite close up above it, but the next day, look what happens. It goes up very, very quickly, very rapidly. And that is the sign of a good breakout. Now, there's some other things in here that we've got to cover. I'm not going to get into all of that right here. In some other videos, I'm going to break some of these strategies down, but you can see just trading very simple breakouts can make you a lot of money. This was a very large upward move, and we actually didn't take profits in this particular move until way over here. So once again, this is a very, very nice breakout. And those are the kinds of trades that we're looking to take. Now, a breakdown is just the opposite of a breakdown. But instead of the market breaking up, it breaks down. But here's the thing. Catching a good breakdown can be hugely profitable for one main reason. And that is that fear often creates larger market movements than euphoria, right? So when a market is going up, everyone who's buying becomes euphoric at some point. Right? They begin to believe that the market will just keep going up forever and ever and ever, and they're going to keep making their profits and collecting their dividends forever and ever and ever. But when the market begins to turn, right, some kind of a crisis happens, or something takes place in the economy, or something takes place in the markets, when the market begins to turn and fear begins to set in, and investors begin to dump their holdings, it creates an environment of widespread selling panic. And this means that the market usually falls farther, faster than it does when it rises, okay? So we usually see much faster moving markets that fall a lot farther when they're in a fear mode than they are in a euphoric mode when the market is moving up, okay? So here's an example of a breakdown. Here you can see in this particular example, this is a downtrending market actually. If you look at the overall trend of this market was in a very long-term downtrend. You can see I have a 200 moving average, simple moving average on the chart here, and you can see once again that this market was in a long-term downtrend even from back here. But the market enters into this range period right here. You can see from this point here to this high here, to a lower high here, to a lower high here. So the market is making lower highs here. It's making higher lows here. It's kind of getting into this channeled type of mode here. And then when the market gets into this kind of a mode, we begin to look for breakdowns in the direction of the particular overall trend. Or maybe the trend is looking to change. Maybe the trend has been up, but now the trend is looking to change. So we can begin looking for breakdowns here. And you can see this was a breakdown here. The black line right here represents the support level in this market. Price broke down below that. It did come back up and retest this area, but then once again you see it shift right back over. This was a true breakdown right here when it broke down this second time, and then you can see that it goes down very quickly, very rapidly, and it goes down very, very far here. This was a large move to the downside here in this particular market. That was the euro pound. Here's another example of a breakdown. There's some other patterns in here that would signify that this market is actually turning. This was actually a market that was in somewhat of an uptrend, although you can see here that the 200 exponential moving average or 200 simple moving average is fairly flat. So that means that, you know, we're really kind of in a no man's land market here, but it has been moving up for a period of time. And then you can see here all of a sudden we get this nice little reversal pattern here, and then you can see that we get a breakdown right here. Boom, it breaks down. It actually closes below this level right here, and then you see it takes off very quickly to the downside, okay? Very quickly to the downside. And that's what happens when, once again, fear is injected into the market. You can see this nice gap right here to the downside, and then it just takes off very, very fast. And we would actually get out of this market somewhere around here in this particular case. That would have been a nice move for you as well. The market was trading up here around 146.20. I'm sorry, about 145 roughly, and we would have exited this market at about 133 or so. That's a big move, right? That's over 800 pips actually over 1,200 pips in this particular move. Over 1,200 pips, you're talking about for every one lot that you had trading on this, that's $12,000. So that's a nice move to the downside, all right? That's what is considered a breakdown there. The market breaks down below a level and it continues down very rapidly, all right? Now, I've had a lot of people rip on me through the years because they think that my trading approach is too simple. They say that it can't possibly be as easy as trading a few breakouts and breakdowns and making money. But listen, I've made the majority of my money by trading breakouts and breakdowns. And when people say that to me, that's when I like to tell them, keep it simple, stupid, right? Keep it simple, stupid. You've got to keep it simple, stupid. Now, I'm not saying that they're stupid. I'm just saying you've got to keep trading simple, stupid. Now, the reality is that simpler systems have been proven to work better over longer periods of time. And over the past decade, as a money-making trader, a trader who's actually made money and traded millions of dollars, I've gone through the cycle of making things too complex and then having to revert to the simple things that were working the best the first time around. So the best way to approach something complex like the markets is to do it with a very simple set of tools and a very simple logic. Now, if the market is going lower, what do I want to do? I want to sell. If the market is going higher, what do I want to do? I want to buy. And breakouts and breakdowns give me the best opportunity to do that while I'm trading in the direction of the momentum and of the trend. So the KISS acronym here that I have, which means keep it simple, stupid, is actually coined, or was coined rather, by a guy named Kelly Johnson. He was the lead engineer at the Lockheed Skunk Works, and he created, actually his team created the Lockheed II and SR-71 Blackbird spy planes. But the story goes like this. It says that Johnson handed a team of his design engineers a handful of tools with the challenge that the jet aircraft they were designing must be repairable by an average mechanic in the field under combat conditions with only these tools. Hence, the stupid in this particular acronym actually refers to the relationship between the way things break and the sophistication available to repair them. So these jets are very sophisticated. When they break, it's a sophisticated problem, but the tools that are used to repair them and the level of mechanics that are working on them in the field aren't to the level of the engineers at Lockheed Skunk Works. So you can use very simple tools to repair very sophisticated, difficult problems, right? Likewise, the market is a very complex machine, right? Economies are complex, politics are complex, and the world economy as a whole organism is extremely complex, right? These are all things that affect the market. But like Johnson's team of engineers, we have to simply approach the market's complexity with a handful of very simple tools in order to succeed at our mission of creating wealth from our trading endeavor. And that's exactly what breakouts and breakdowns do. That's exactly what going long and going short is all about. So stay tuned for the next video where we'll start to dive into some real meat and potatoes. I'm going to talk some technical analysis stuff with you. So I will see you then. Be on the lookout for that email.